It's one of my favorite times of the year. No, not tax time. Who wants to pay taxes? And no, it's not that the market was crashing. We don't enjoy that. It's time to pay my life insurance premiums. In fact, I just got to pay it. Now you might say, what kind of crazy person gets excited about paying their life insurance premiums? I do, and you're going to find out why in just a minute, because I'm going to update you on year 6 of my Guardian policy. This is a very large policy that we took out on my wife. I'm going to tell you why we got it, what our plan was when we started it, and where's it at now in relation to where we expected it to be just a few short years ago. And then you will hopefully understand why I like paying premiums into my policy. Welcome. My name is James Barber, your Oregon Cash Flow Pro. Let's jump into this. Now, this is a Guardian policy, whole life, 95. I picked this up 6 years ago. We just had our anniversary, so I just made my 6th premium payment. When we started this policy, the idea was we're going to fund this policy very heavily for a number of years. I think the plan originally was we start off with a base of $5,000, basically making monthly payments of $500 a month, which some of that payment each month goes towards paid up additions, and most of it goes to the base. The original plan was to fund it at $60,000 a year for the next 10 or 11 or 12 years. I don't remember which one of those. But the flexibility of this policy actually allowed me to fund it at a higher level than that. And if we fund it at a higher level than that, the policy is going to be more efficient. And ultimately, instead of my funding period being 10 or 11 or 12 years, it's only going to be heavily funded for a little over 6 years. After that, it's going to drop down, and we'll just continue making small premium payments as long as we want to after that. And all the extra cash flow that I have at that point that's no longer going towards making big premium payments is going to either go to other life insurance policies, or I'll just focus on paying back any type of loans that I might have outstanding as we're doing our infinite banking with this stuff. This is what this policy looked like a few short years ago. This was our 2023 update. You can see the projection with policy year 4 on the guaranteed side of the ledger. By year 6, we were expected to be at $408,000. On the non-guaranteed side, by year 6, we're expected to be at $417,000. And you can see the types of payments. I'm going to show you 3 illustrations. Each of these illustrations, I'm max funded with as much as it would let me do inside the software illustration without causing a modified endowment contract. And each carrier has their limits with what will be allowed to illustrate. Guardian, however, allows us to fund more than what I can actually illustrate without having to go through underwriting. So you can see the projection was I put in $50,000 for each of the next 3 years, and then it would drop down to $35,000. And then after that, I would put in $6,000 a year for a number of years. Fast forward to last year. Last year, we have actually funded it at a higher level, and it let me illustrate last year putting in $72,000. It didn't leave me at $50,000 this time. And instead of year 8 being a $38,000 payment, year 7 is now projected to be a $33,000, and then it's $6,000 a year after that. But look what happened to the dollar amounts. My guaranteed cash value in year 6 is now $457,000, and the projected growth based on the current dividend, $464,000 by year 6. Let's go back here. We had $408,000. Now in the guaranteed side, we had $408,000. Now we're at $457,000 by year 6. We're at $417,000. Now we're at $464,000. Well, I funded it at a higher level. Instead of putting in $50,000, we put in $72,000 over the course of that year. And then in year 6, I put in $72,000. So of course, we're going to have a higher cash value in here on the guaranteed side and a higher cash value over here because I did fund it at an extra $44,000 above and beyond what I illustrated from that year before. But how much are we up? If I put in an extra $44,000, this went from $408,000 to $457,000. I put in an extra $44,000, but our guaranteed value is $49,000 more. We like to see that. On the non-guaranteed side, it went from $417,000 to $464,000, the $47,000 increase. A little bit lower than the guaranteed, but that's because we're getting dividends. We actually expect the non-guaranteed part to perform better than the guaranteed part. Now, cash value down the road, let's go to age 58, year 18. Guaranteed cash value, 774. Non-guaranteed, 855. Now by year 18, this was last year, remember, 783 and 876. 783 and 876 compared to 774 and 855. Let's look at this year. We've just made our payment. We did an updated projection. Our guaranteed cash value is now 461. The year before, 457 was the projection on the guarantee. So in just 1 year, and I funded it at the exact same level that we were projecting that I would fund it here, but we're up a bit. And then on the non-guaranteed side, we're at 466, where the projection was 464. So we're outperforming the in-force illustration from last year, and we're way outperforming the illustration from the year before. Again, this is 2023. Projection on the guaranteed side, 408. Non-guaranteed, 417. And we are at 461 and 466. Now you can see why I get excited about putting my money in here. Now, I watch the stock market every single day, and it is crashing right now. And people are freaking out. Rightly so. They're concerned about all the money that they've been saving up. There is no protection in the stock market to keep your value from dropping. Whereas in a policy like this, it only goes up every single year. And on the guaranteed basis, just from the guaranteed basis, by the time we get to year 18 now, it's projecting 838, 910. Last year, the guaranteed at year 18 was 783. The year before that, by year 18, the guarantee was 774. So we're continuing to see on a guaranteed basis, the policy continues to outperform even what I've illustrated in the recent past. From 2 years ago, 774 to 838. That's about $64,000 more just on the guaranteed side. On the non-guaranteed side, 962 and 855. That's $112,000 more by the time we get 18 years into it. Now, there is one change that I made here in this year. You notice I'm putting in $10,000 a year now. It's letting me illustrate $10,000 a year, but I have to stop those down here. So I am actually getting more money in here over this time period. I was putting $6,000 a year extra in here, but in year 7, this was at $31,000. A couple of years ago, I was going to be putting in $50 and then $35. But all of these years were projected at $6,000. So we know we put some extra cash in here. So you might say, how does it look down the road? You ended up putting more money into this policy. Let's go all the way down to age 75. At age 75, on a guaranteed basis, we're going to have $1.4 million in here. We didn't put any money in this whole time. And on a non-guaranteed basis, using the current dividend rates, we're going to have over $2 million in there. $2,014,000. 2 years ago, at age 75, we were projecting $1.3 million and $1.7. Even though I'm not going to be funding it in all of these years at this $6,000, we're going to have $100,000 more over here. How about last year's? Last year, at age 75, we were projecting 1.357 and 1.796. We're beating both of those numbers. It's only been 1 year. Let's look at the cumulative outlay here as well. By age 75, this was projecting a cumulative outlay of $598,000, where our net cash value would be 1.796. And this year, looking at 75, we're only going to have funded it at $553,000, and we're going to have $2 million in there. 553 last year, by age 75, we would have had 598. We were going to put in an extra $45,000 under last year's projection by age 75. And we were going to have let's round it up to 1.8 million. And now the projection is I put in 553, I'm going to have over $2 million. That's a $200,000 increase just by accelerating my funding a little bit up here and then not putting in as much here. Sign me up. I love these things. This is what I use for my infinite bank. It's one of my policies. I have a bunch of policies. I will be updating you on each of these policies every time we hit an anniversary. You can always go back and look at the videos each of the past years on all of my policies. I share them with you. I think it's important that we're transparent in these things. See, I'm not just the president of Oregon Cash Flow Pro, I'm also a client. We're going to look at one final piece here, just where you can see these things side by side. This was the in-force illustration I did this year. That was the in-force illustration I did the year before. You can see the dates. And then the in-force illustration the year before that. So you can see we're right at a year apart. The only difference being this one, which I did right before the anniversary. But we projected the funding to be what we funded that following year. And then you can see here, by age 65, 2 years ago, the projected cash value, 1.108. By last year, 1.144. And by this year, 1.280. At age 75, going from a couple years ago to now, almost a $300,000 increase by age 75. And by age 85, that's a $455,000 increase. And remember, I'm always projecting a max funding of this policy. Anytime we own a cash value life insurance policy, the most efficient use of it is to max fund it. So that is my number one goal each year and why I get so excited about it. If you have any questions about my policies, if you have questions about your policies, if you want to look at getting a policy, you can leave questions in the comment section below, and you can find my Calendly link, schedule a meeting with me if you'd like to have an in-depth conversation about your personal situation. I appreciate you joining me. If you want to understand more about whole life insurance, hit that like button and subscribe to the channel. We'll see you next time. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.